Thank you very much. I'm very, very pleased to be here this afternoon with you, because I think it's all about the next generation, about the people who are now getting ready to go into the work life, international work life, and the motivation that you bring to the table, and also the aspirations and the intentions that you bring to the table. And I will share with you a little bit my story and our story of how that developed over the years, and now almost decades, getting older. But it gets, even better over time. So don't worry about that. I will actually talk about these different names up here at our foundation and Social Impact International as part of my personal story. So that's the first part of the talk that I have prepared for you. And then the second one is actually what we focus on right now and what change we want to actually do over the next few years and a couple of decades. And I hope that I see a lot of interesting thoughts in the first half of our conversation or discussion, such that we can actually have a good debate and discussion in the second half of this session. So you have detected probably a slight accent, which is true. And so I grew up in Innsbruck, which is in Austria. It's the skiing capital, or one of the skiing capitals in the world. And I was quite incompatible with my dad at the time, which prompted me to look for opportunities to leave Innsbruck. And I applied for a scholarship, which was AFS, American Field Service, which allows non-U.S. Students, high school students, to come to the U.S. and spend a year with a family and go to school here. And they chose, miraculously, Hawaii for me. I had nothing to do with this, because you cannot say, I want to actually go to Alaska or Nebraska or somewhere else. So the algorithm that mapped students to families obviously worked well. And the most, supposedly I studied there for a year, which was great. I studied a lot of surfing and Hawaiian. And I met Lisa, my wife, there in 1974, 75, so almost 40 years ago. And so unfortunately, I had to go back to Austria, to Vienna. And I decided to study computer science in Vienna, 1975. So the first year, we actually had to do coding with punch cards, but then we got Apple IIs, and then, I stayed in Vienna, and we had our kids, which are now here, you see here, as young adults, not back then, in Vienna. And, societies are interesting, because societies either enable you to self-actualize, right, in what you really want to do, or they don't. And at that point in time, the Austrian society was quite conservative towards non-Austrian professional women, which my wife is one of those. And so she said, well, they make it very hard, to work there and be entrepreneurial. And therefore, she said, let's go to the US. And I said, okay, if we go to the US, let's go to Silicon Valley, because that's where I could actually self-actualize my dreams about implementing the coolest technology on the planet. So I have a PhD in distributed systems, and I'll share with you a little bit which ones I was involved in. But that was really just the precursor to moving on yet one more time, and that's to Big Sur, which is down south a little bit. And the reason we moved to Big Sur, which will become clear to you in the first 45 minutes, is because we changed the impact that our lives, that we want to have with our lives. And you want to go to an area that actually inspires you to do what you really want to do. And Big Sur is a very inspiring landscape with a lot of positive energy, also challenging energy once in a while, that enables us to reflect on the purpose of our lives and what we want to do with that. You see here our beach property and the mountain property, which I just left. One of the trees, which is a big inspiration for me. You know, when we had an arborist actually go and check out our redwood trees, they said, I said, how old is this tree? He said, well, between 800 and 1300 years old. And he said, do you want me to drill a hole so you know exactly how old? I said, no, it's roughly 1,000 years. That's good enough. And so in that, you know, I think it's important the location that you choose to hang out with, as well as the work that you do. And I moved also from big companies all the way from the university in Vienna to HB, which brought us over here to Silicon Valley, to then say, oh, let's actually, digital, nobody remembers here anymore, it's part of HB now, to the startup scene. And I was very lucky to have been able to work with Steve Jobs at a company called Next in the 90s. And I was responsible for, I'm very grateful to see all these System 10s working on all these laptops here, because I developed OpenStep, which was the precursor of System 10, which is running on all of your iPhones, iPads, and Mac Airs, and what have you. And I share a little bit of my of a couple of observations, you know, that I have with respect to leadership and conscious leadership in a minute about this part of my life. And then I worked for RightPoint DataMind, which we sold to Epiphany in the late 90s for $400 million. And my masterpiece, so to speak, where I really combined what I learned from Steve Jobs about highly effective teams to really building the biggest transaction platform on the planet, is a business-to-business e-commerce company called Ariba, which we went public with in 1998, and which was an independent company until this year, actually, where it was bought by SAP for about $4.5 billion. So I'll tell you a story about SAP, because I tried to do a partnership, a business partnership with SAP in 1997, and then Dr. Hasso Plattner, the then CEO of SAP, was here in the Valley, and Keith Kroc, my CEO, and I went over and said, hey, do we want to collaborate and partner? In the end, you know, being typical German, he said, look, guys, I built the car, meaning SAP. You can build the radio in my car, and I play the music on my radio. And I said, well, that doesn't look like a great partnership. You know, partnerships go like partners, hello, you know. And so they, in the end, bought Ariba for $4.5 billion. He could have had it a little cheaper, you know, about 20 years ago or 15 years ago. In any case, you know, when you create a $10 to $20 billion company and you own 1.5% of the company, you don't need to have a PhD in mathematics to understand that that actually made us quite rich. Not only our shareholders, but us, right? Which we didn't really plan. So, I mean, I planned to go to Silicon Valley to have fun and implement the best products on the planet, which I did. And so here I was with 45 and achieved that, which is interesting, right? Because it poses a couple of fundamental questions about meaning of life and meaning of wealth, and how capitalism works and how philanthropy works. And fortunately for me, Lisa, my wife, and I, we were on the same page on that one. We didn't confuse our genius being causally related to our wealth, and therefore we actually consider our wealth to be a gift that we are responsible to steward towards positive impact. And so what that did to us is we actually asked, you know, once you have wealth advisors, and the wealth advisors, they want a lot of money and to do their work. And we say, well, we want to do something good with our wealth. So back then, that was actually not a question that was commonly, you know, asked of these wealth advisors, because they just say, normally, you want to maximize your financial return such that then you can maximize your grant giving capacity, which is sort of absurd at best. Because especially if your money actually counters what you care about in your values and in your life, right? And so in the last 10 years, you know, we have aligned our lives with positive impact. And anything that we do, we strive towards actually making sure that it's in alignment with our values, which I will share in a minute, and what we believe in. So before we go into that, I wanted to actually share a couple of leadership lessons. And since I worked for Steve, and he was I was a big fan of his, I just want to point out a couple of things that made him successful. He was also a very driven person, and very difficult at times, right? But for instance, one thing that inspires me is when behind leapfrog. So we are at the state of humanity and the financial systems that is not the best of states. And I will make the argument to you tonight, this afternoon, that if we don't change course, right, that the bad things of how wealth is deployed are actually going to become bigger, not smaller. And so when behind leapfrog, so I'm working very diligently together with a lot of friends around the globe in changing the financial systems such that they will be realigned to have a positive impact and not these god-awful externalities, as the macroeconomists conveniently call them, that might burn us up because nobody can figure out how to make them internalities. And we don't accept that as a premise. Also, sciences and humanities, I was always intrigued. I'm an engineer by trade, right? And Steve is not an engineer. He treated us engineers quite well. But the combination of talents really made the magic happen, not just one or the other. And another lesson that I've learned and observed and practiced myself is that successful leaders actually go back and forth between seemingly incompatible or opposed types of attributes. But they know how to choose the one that's right for wherever they are. And organized and spontaneous. If you're always organized, always have a plan, then you're a manager, an administrator. You're not the leader, right? If you're always spontaneous, well, then by accident, maybe a few good things will happen, but it will be a real accident. And similarly, we can explore these themes. I key them up later if appropriate or not. I think it's very, very important to figure out how you can lead and serve at the same time or in different times. And I share a few efforts that I'm involved in where I'm a real servant to everybody else, and sometimes I get to lead, and it's more fluid these days. It's not line management anymore. And I share a couple of organizations that I get to work with that really do that on a global level now. And but I'm actually most interested in impact leaders, conscious leaders, in leaders that usually are not the leaders of they're not leaders of the current multinationals, because the current leadership to be successful on that level requires sometimes a lack of authenticity, a lack of integrity, a lack of awareness and consciousness, because you do things that you should not do. And so a radical commitment to authenticity and awareness and transparency, I think, is the call of the day, and in all aspects of life, I think. And without this, I'm okay if society decides fully aware and fully conscious and to choose something in a transparent way, as long as you know it, right? But if you don't know about it, that's not okay anymore. And so you will be challenged, right, in your careers over the next few decades in really leading an authentic life and leading with integrity and awareness and the right level of consciousness. So I talked a little bit about our entrepreneurial approach and the leverage that I like to see in everything that we do. And I want to now give you a little bit more motivation about why I do and we do things that we do, and they have to do with our values and the challenge of actually, for humanity, that is, the challenge of living within the capacity constraints of a limited planet, right? And so holistic sustainability. And so my values I define as integrity, courage, and joy. And I take integrity serious to the point where I want to live a life that's in utmost alignment with the purpose of my life. That's how I define integrity. And so it's not lying or something very superficial, but once you know, and I share the purpose of my life in a second, then you actually have to really work on that. And the more intentional you are about this, the more magic happens. And that really is not credited to you as an ego or as a skin encapsulated body, but really to your soul, right? Of who you really are, not just the body or the mind, but the soul. And that we have the courage to choose at the point when you actually can make choices, to choose the right things. And if you just catch that point before you make a choice, you will know what the right choice is. Just start to listen, do that in your career choices, in how you choose to live your life, in how you choose to live your time. And important, since we are here, at least temporarily, might as well enjoy the body and your mind while you have it. And so I'm fully signed up for that as well. So, but I want to talk about the more global themes of what also inspire me. So we talked about we as human beings, why we need to do what we need to do. And I hope I convinced you that not only do I have the deep desire, but the conviction and the intention to live a high integrity life that actually makes a positive impact. Now, when you also combine that now with understanding where the globe and humanity is really traveling towards, then the defining challenge is to get to sustainable development is that everybody on the planet is able to lead a fulfilling life without degradation of the resources. And capitalism arguably is okay on the first part, not totally, I'll make that argument too, but really the side effects of capitalism sometimes really have a very bad side effect on the planet and the resources of the planet. So once you start, so you need to study that, because as soon as you need to study the system such that you know how to change it, right? And so for those of you who study MBA, you will learn how the system works, and then if you decide to actually change it to the better, great, then you can do it. You know about the world population resource constraints and something that's called modern portfolio theory. That's clearly wrong, yet everybody pretends as if that's how investments should be done. And so the perpetuation of clearly wrong assumptions is something that I actually don't really understand. Seemingly intelligent people, right, they pretend and act as if it doesn't happen. So just to give an example of modern portfolio theory, how it works is they say everything actually happens in a perfect market. There's no perfect market. They say that we're all rational investors. I mean, I've not met one yet. I'm not one either. And so we all have our biases, right? They say, don't worry about the externalities. It's okay. It doesn't really matter, right? And if we mess up the planet and mess up the societies, don't worry. So those are things that we actually need to fix. And the financial system right now, I told you I've built really large distributed systems with resiliency built into it. Like I was inspired by nature, by recursive algorithms, how they seem to apply in nature, by redundancy, by replication. And so the Ariba system, even if some nodes go down, it will not stop. The financial system right now is built to maximum efficiency, which for you who understand systems and think systemically is not a good position to be in. You need to build the resiliency into that system again. Just like biodiversity, right? And nature teaches us how to do that. So we're in a new era, and some call that Anthropocene, and it follows the Holocene. And the Holocene is those 10,000 years when humanity really thrived to the point where we are now. A stable climate, resources, up to 1.2 billion people only 150 years ago, right? And now, for the first time since the Industrial Revolution, arguably, humanity is in a position to actually have a significant impact on the biosphere on a planetary scale. And that, I submit, requires different ways of thinking, right? And for me, people who think that a system that was invented 150 years ago when we did have 1.2 billion people on the planet and seemingly unlimited resources, if they think it doesn't have to be reinvented for an order of magnitude more people with limited resources, I don't understand that position. I'm very inspired by the Global Footprint Network done in Oakland over there that have a very, very scientific and profound way of analyzing how many resources we actually use. And today, humanity uses about 50% more resources than is regenerated by the natural systems. So we need to change that trajectory. And I think that investment and money and capitalism is one big way of doing that. So, so based on all these trends and my conviction, here is my purpose for my life, right? And it's like three main portions. One is to enable social entrepreneurs go to scale sustainably and with bigger impact. And you're interested in social entrepreneurs, and so we call them impact entrepreneurs or whatever you call them. But really, the main item there being that they have a social mission and or environmental mission that's positive, right? And the corollary to that is that I am helping capitalism, market economists, and philanthropy to actually support the right level of investments to the right level of entrepreneurs. And that does require a blend a lot of times. And it requires an explicit measurement of the impact that we have, the positive impact. Otherwise, how can you prove that you have a positive impact? And inspire others to lead a purposeful and values-driven life. So that was the first part. So the second part of my talk is now what I'm doing right now to actually actualize the purpose of my life, right? Since I know what it is, I better get going on that. And I'm going to talk about three items here. One is our foundation, Charly Kleissner Foundation, and then capacity building for entrepreneurs and investors. And the last piece about modern global networks that all need to be in place in order to actually accomplish what I set out to do with my life. So Lisa and I co-founded our foundation in 2001, and it, not surprisingly, is there in order to enable, again, social entrepreneurs go to scale sustainably, right? And the second piece now that developed over the last 10 years is what we call impact investing approach. So most foundations operate bifurcated. They give out grants on one side, and they invest their endowment on the other side. And usually, these two sides don't talk to each other. As a matter of fact, most foundations are run such that they maximize their financial return in order to actually give out more grants. And superficially, that seems like it makes a lot of sense. But if you dig in a little bit and you actually see what the endowments are invested in, then a lot of times the investments actually counter what the foundation is set up to do. So I get to talk to a lot of great foundations, and especially the green foundations in the US. They are now, for the first time, actually starting to say that they need to divest from the negative implications of climate change. And to give you a sense of what that really means and how people think about this is, first thing is always negative. They want to avoid the worst offenders. They want to avoid the bad things, right? And that's there is actually history in the US about this, avoiding the sin stocks. And you could tell your investment manager to avoid alcohol and prostitution and guns and what have you, right? And so the 15 worst offenders in climate change, everybody pretty much, except for the 15 offenders, agree that they are the 15 worst offenders. And so it's fairly simple to say, okay, I'm not going to invest in those, right? But then if you actually think about, well, that's just a negative avoidance as opposed to a positive contribution to alleviating the issue in the first place. So us impact investors are not happy to just avoid the bad things, but we want to use our capital and our investments to make a positive contribution. And so in that particular instance, it would mean that you would have to divest yourself from all carbon, investments, and then reinvest in renewable energies, in carbon offsets, in biodiversity, and things of that nature, right? And we have done that over the last 10 years. And that's called impact investing. And so impact investing is actually a small movement, but it's small in the grand scheme of things. And I talk about that a little bit more. It's small because the most capital is actually in pension funds. and the most pension funds are in the US. There's about $38 trillion in pension funds. And so if we don't really change the pension funds, and our $2 trillion that we have in high net worth individuals and back offices are just going to be a little rounding error on the big capital. And so I will have to prove to you that we're on track in changing that later a little bit. So we invest, to give you a sense, in Health Point Services, for instance, EHP, which provides health services to the rural population in India. We invest in Beartooth Capital, which combines conservation of land to limited development of land, not one or the other. It's a combined land use plan which we think is appropriate. And we made actually pretty good financial results with this strategy. So one thing that people ask me that you can also do is, where do you put your cash, right? Everybody has cash. And, and we demand transparency of our cash. I don't want my cash to go to the weapons industry. I don't want my cash to finance the wars. I actually want my cash to go to the local community. I want my cash to be positive in supporting entrepreneurs in the local community. So if that's your values, right, then you need to say, well, I want to insist on that. Because otherwise your money works against your values, which would not be a good thing. And so you do a little bit of research. If you actually don't believe that that the dirty coal is something that should be supported anymore, and you understand that Bank of America is actually financing most of the loans of the dirty coal industry in the U.S., well, then you probably won't give your money cash to Bank of America, but somewhere else. Good. Where? Well, the good news is there's lots of great opportunities in the U.S. and all over the world, to do that. And Southern Bancorp and New Resource Bank here in San Francisco, they are very transparent, RSF Social Finance, about what they do with your cash. So the good news is we can all do that, and we don't have to give the money to the banks that don't provide that transparency. What about commodities and real assets? It's a very, very, very important asset class for impact investors, because you're very close to the assets if you invest in real assets, right? But the bad news is that all extractive technologies, mining, is not really good, not only to the miners, but also not good to the land, because they usually leave a lot of chemicals in the land, and they're not held accountable for cleanup. And therefore, we cannot do that either. So we don't invest in oil, we don't invest in extractives, in gold. But fortunately, we can invest in all these great investment opportunities that do biodiversity, mixed land use, renewable timber, right? I mean, at this day and age, we should get superior returns for renewable timber. Yet, sometimes you don't, and it's a systemic issue, because cutting down trees and not replacing them is actually counted positive as a GDP factor, right? And so nations who cut down trees and don't replace them can boost their supposed economic progress. They call it that way, yet it's actually destroying everything else. So we need to not only do impact investing, but we need to reinvent the way that it's counted, and need to go to the, our Bhutanese friends, they have the National Happiness Index and things of that nature, which is good. We do we do dozens or so direct investments in small companies. So recently, we got intrigued by companies that actually work with creating movements, right? Global movements. And so we investigated change.org and purpose.com, and we decided to invest in purpose.com. And so we learned how to do that, because ultimately we want to make impact investing a worldwide movement that goes all the way from institutional capital to the retail capital that you have in this room. And so to finish up the story about our foundation, we are pretty much 100% into impact, positive impact, about 93% right now. And the question always is, do you need to take a financial haircut or not? And I'm glad to get one more X today. And we just proved, because we published our report, and you can download it from our website if you're interested, that we actually have very competitive financial returns in all asset classes compared to non-impact investments, which is a first in the industry, and which has to be proven in order to motivate more money to come in. Of course, we care about the impact as well, which we might get into, in our Q&A session discussion. But let me move on to a couple of other things that we do. And that's capacity building. So, the fledgling social entrepreneurs who are not trained as entrepreneurs, who don't really know how to read a P&L, who don't really know how to manage towards cash flow break-even, who don't really have that know-how, they need, and they don't have access to business schools like this. They need what's called capacity building in the not-for-profit sector, peer-to-peer learning, mentoring, and we have, with our grant capital, actually through Social Impact International, worked with quite a few incubators. It's like an incubator of incubators, right? Where we train dozens of entrepreneurs in creating impactful enterprises, and some of them then we actually invest in or make sure that other people invest in them. And particularly, the first one that I incubated was Dasra Social Impact in India, and there we do about 30 entrepreneurs per year, and all the way. There's actually a couple of ex-Stanford people came through 2 years ago, like the baby warmer. What's it called now? Embrace came through that. Yeah, Husk Power Systems came through that. BioLite, which we invested, came through that. So quite innovative social enterprises, right? That make a big splash and really make a big impact. And Lisa is doing the Hawaiian Investment Ready program, which is focused on indigenous Hawaiian entrepreneurs. She's part Hawaiian. Her great-grandmother was 100% Hawaiian. And for culturally appropriate enterprises, right? That actually do land use the way that Hawaiians did it, that recultivate the language and the culture, that we collaborate with local food production for local food consumption, fish ponds that are revitalized, things of that nature. And so the last piece that I want to really key up a little bit is global networks. And, I'm very intrigued with respect to where we are as humanity vis-a-vis technology and what enablement we have across humanity, and how important that is in conjunction with regional get-togethers, physical get-togethers, and really comparing notes on an eye-to-eye level. And so I think the magic is really at this stage the combination where you have physical instantiations of people collaborating together with a backbone that's global, that does either member management platform, or transaction platform, or due diligence platform. And one of the boards that I'm on is the Impact Hub. There's multiple hubs in the Bay Area. You might be familiar with the one in San Francisco. There's one coming up in Oakland. And there's about 50 hubs all over the world, going to 200 hubs. It's a beautiful movement. And we have a very powerful membership platform behind that enables the members who participate in these hubs to collaborate on different levels. I think similarly, Tonic is a global network of active impact investors, people like ourselves, where we collaborate globally to channel money into these social enterprises. And so it's about 60 investors across the whole globe, including India, South Korea, Brazil now, Hong Kong, Australia, and the majority is still being NATO-ish in North Atlantic in the US and in Europe, but moving rapidly again into a global movement. And by practicing radical transparency on the due diligence sharing, we actually turn the classical angel model upside down, where we are able to syndicate capital from all over the world to all over the world. And so I'm very, very jazzed up about that one. And that then inspired me to create a subset of asset owners, and I call it the 100% Impact Network, where it's asset owners who have intentionally committed 100% of their assets to positive impact. Now, that's an interesting proposition, because it takes away the safety net of high net worth individuals, where you say, oh, hey, if you have 100 million and you carve out 20, who cares, right? You're not really putting everything on the line. And so in this instance, I have 27 collaborators, and all the way from $5 million to $500 million portfolios, and they go 100% in. And so interesting questions arise with respect to, let's say, an art collection, right? If you have 500 million, maybe you have some art lying around and are a collector. And some people ask me, what about, Charlie, is that impactful? I say, well, think about it. If you think that art is a beautiful expression of humanity and you support young artists to express themselves and buy their work, and then, in order to do that, of course it's impactful. If, on the other hand, you buy the latest Cézanne and put it into your safe and then flip it around at the maximum financial profit, I don't have to tell you that that's not very impactful, right? And so you see seemingly difficult questions, actually, if you reflect on what they really mean for you, are not that difficult to handle. And that is my Trojan horse now in order to really change the industry, because in that, we have about $2.7 billion aggregated amongst all of ourselves. And that enables us, again, it's not 38 trillion, but it's getting to the point where, people start taking notice of us. And if in the next 2 to 3 to 4 years, we can actually prove that we can build these multi-$100 million portfolios with impact and financial return, that then will give us the conviction to regulate the big endowments and the pension plans to say, no, you can't do that because we have proven it. Here's how you do it, right? There's also a small movement emerging to democratize impact investing. You might ask how you participate in impact investing. It's difficult for you to do that because you don't have that many assets. Yet, I told you about cash. I told you about RSF social finance. There's more crowdfunding platforms coming online. We know all the people who are working on that, so you can finance individual projects like over Solar Mosaic, for instance, or Crowdfunder, which Tonic is partnering with. And there it's beautiful. You can invest $1,000, right, and or less, $100, to participate in as an impact investor on that level. It's not robust yet. I mean, the Jobs Act 3 was just passed now, and it will be implemented in April. But the U.S. being in the U.S., there's tons of people working on enabling these platforms. And we need new products, right? Because it's not acceptable, for us to invest in the old extractive technologies. How can we create products that actually, where you treat the people and the planet really? Did you have a question? Yeah. 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 I'm almost done, and then we go into questions. Yeah. 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 So the foundations, actually, let me respond in two parts. The foundations in the U.S., are obligated to, so they're not tax shelters in the U.S. In Europe, partially they are, depending on which country you're in. But in the U.S., you cannot really use the money unless you give it to charities. So that's by law. You cannot, if you manage it yourself, you can pay yourself a decent salary, and they're checking that, right? But that's about it. And so the U.S. law says that 5% of a foundation needs to be paid out per year, either in grants or in what's called program-related investments, which are below market investments. And the rest is not regulated. And the rest is what we talk about should move into impact investing. Then the 95%, because right now the foundations, look at it, a foundation gets the benefit of gets the tax benefit from society, right? So it doesn't pay any taxes back into society in order to have a mission, right? In order to implement the mission. If the mission is, to help the planet become more green, and you invest in dirty coal, that doesn't make sense, right? And so I think that the regulatory framework over time will actually not allow the corpus of the foundations to knowingly mess up the mission of the foundation, which is one step towards then making it more positively. When I talk to hedge fund managers, which I do now, I make the case of you should be in impact investing in order to hedge against the next downturn, because a lot of our investments actually didn't go down in 2008, 2009, because they were not correlated with the system, right? And they understand that. But it's not sticky unless you actually change the energy around and say, instead of trying to avoid a negative downturn, you want to invest in the positive self-expression of the planet healing itself, right? Through money. And that, so about 5% of the hedge fund managers actually do understand that, and they come up usually, and then there's maybe one in the end that's still talking to me, and I say, in order to do that, you need to transform yourself. But that's an elevated, argument that most hedge fund managers cannot follow yet. But they will, right? I mean, it's, everybody is at where they're at. So, and then so the 100%ers actually are 35% foundations and 65% back offices that don't have a foundation. So I eased into that through various ways. Okay, so we talked about this a little bit. So we're working on the new principles of investments, right? Of investing for this age of humanity, and it's really taking responsibility again for your investments, right? Not day trading, not delegating that and saying, "Oh, this is really not part of my problem." If you have a 401k, we're working on getting 401k plans so that you can choose your impact investments as part of your 401k plans. As you have a life insurance, we're working on with the life insurance industry such that they can actually offer the life insurance with impact investments. So you see that we're working on all these things so that we can actually change the current non-sustainable way that the system works to a sustainable way, and so the impact industry is emerging, and ultimately we can drop impact from the investment side again, because all investments should be positive, not negative, right? And I think that that's a good vision to have, and should not be too far off. And with this, I want to conclude the talk so that we have 40 minutes of conversation with a hero of mine, and that's Bucky. And he is a big system thinker, and of course I believe in that, and so are you. Otherwise, you would not sit in this class. And last but not least, I really want to leave you with something that really brings home the responsibility that we all have. And your life ultimately is the expression of who you really are, and you cannot pretend it's not, because you make your choices. And so on that level, I hope, wish you the best for the choices that you make to really realize a life that you're proud of in the end. And with this, I want to just conclude my remarks and go into a discussion here. Thank you.
What is the one metric that you found across the board to be the best indicator of a positive impact?
Mm-hmm. People can't understand the questions, right? Or should I repeat it? Repeat it, yeah. So if there is a single metrics of impact, what is it across, most, if not all, investments? And so there's no single metrics actually that you can deploy. And what we do is a combination of quantitative metrics, and I share a couple of them, with qualitative metrics, with stories. And there's a good reason for this, right? Because measurements in and by themselves, they never tell the whole story. And if we were to confuse metrics with the whole story, we would fall into the same trap as the financial analysts fall. And they sincerely believe that the few metrics that they use are the reality on the ground, right? And therefore, but the reverse, the corollary is true too. If you just tell stories, it's really not good enough, on many levels to be able to satisfy your legitimate need of comparing things, right? And so to give you a sense of what metrics we use, and you can check that out on our website as well, klfelicitasfoundation.org, we have about 5 metrics across all investments that we do, and that's jobs created, clients served, and 3 financial metrics, because and what we look at is how the relative mix of grants versus subsidized capital versus commercial capital changes over time. Our hypothesis being that if you actually move away from grants and get more commercial capital, that will be a leading indicator for impact. And so we do believe that financial metrics serve a good purpose on that level. And then on the different verticals, we augment that with 3 or 4 vertical-specific metrics. Verticals meaning, is it health? Is it education? Is it water? And so we have very specific ones. There's emerging standards coming out. The terminology is called IRIS, I-R-I-S, and it defines the meaning of the metric itself. It's just a terminology. So if you say I created 10,000 jobs, you mean full-time jobs around the year, not half-time or seasonal or whatever, right? You see, then you can actually compare. And there's gears ratings coming up where there's companies that actually rate social enterprises and funds according to different criteria that are environmental, social, and governmental. So we can dive into that more if there's more questions around that. Yeah, back there.
Yeah, so thanks for your story. It's very inspiring still. What I was wondering is you're really committed to bottom-up change, right? Seeing you have your money you invested, you try to bring people together with a similar view. But of course, there's a huge potential in top-down change, especially when you think of the huge pension funds you discussed or some of the law funds.
Yeah.
So what would be the best way to actually internalize the impact way of looking into their operations?
Yeah. So on the pension fund side.
Yes.
For instance.
In general, so
yeah.
How can you make all the financial flows and will take into account
So the question is really, and particularly for the big what's called institutional capital, which is the big banks and the pension funds, how do we influence them and influence them to take impact investing not just serious but actually do something, right? If I can paraphrase. And so I told you one strategy that we deploy, right, and that will take a few years, and it will provide one big data point, because what the fiduciaries of the pension funds say right now, particularly in the U.S., is that we take more risk, and they are not allowed to take more risk in order to deliver the returns. And if you understand the pressures on the pension funds to deliver 7.5%, or 8% return, which is almost impossible over the last 5 years, certainly, in order to make it work, you can see that argument actually, as long as we cannot counter that argument with real numbers, will be hard to overcome. Yet, at the same time, I think there's an argument to be made that pension funds and big institutional capital should carve out multiple hundreds of millions of dollars that we could deploy into impact right now, such that they can actually co-develop the products that they need ultimately. They have also a big issue of they're so wealthy that they need to deploy billions of dollars actually, right? And if they were to deploy that, we would not have the products today to actually digest that amount of money, right? Because there's not that many positive investments that you can do. You can do. Yeah. So that means that we also need to develop that whole supply and demand side in parallel, right? Which we need to do. And lastly, I think we need to re-evaluate the current assumptions behind risk. And so I shared with you, right, that long term, it seems to be a no-brainer that if you align your long-term investment strategy with holistic sustainability, that you would be rewarded long-term with a lot of financial benefit, because it will have to happen, right? I mean, since it will have to happen, the question is when and how fast and how long and how much disruption will it have, will there be until we get there? And those are difficult questions, right? And most financial managers then say, well, I don't really want to deal with this, and I continue on the path. It's not sustainable, just not seeing it, even so everybody can see it if you want to. And that's hard to overcome, right? Because unless you regulate them from the top down, which they will resist, because they will say, okay, if you regulate me, then I cannot guarantee you, and you will have to refinance me with public money, right? Which is going on all over the world a little bit, right? If the pension funds are not capitalized correctly to actually deal with the requirements. So there's no easy answer to your question. It's multi-pronged, and I think we need to work on all of them in parallel, just like any systemic change requires that. back there and then in front, yeah.
Some people argue that investment only has an impact if it has additionality, meaning that if you didn't make the investment, other people might not, because a socially impacted, neutral person wouldn't make that investment.
Yeah.
And when I see you saying that you won't need to take a financial haircut to make these investments, it makes me wonder whether you think your investments do have additionality, or if you use a different way of measuring your investment.
So additionality argument goes something like this: that you should, hardcore or whatever real impact investors, should only consider their investments an impact investment if other capital would not flow into these investments anyway. In other words, if you invest in it, it's additional to other capital that otherwise would not flow, right? And it's an academic argument that is academic at best, in my opinion. And it's written by an academic, actually, and it's practiced and was put forward by somebody who was actually the leader of one of the biggest foundations in this valley. And at the time that he was heading this up, he actually did not believe in impact investing. And it's good to have converts. I think it's about time to have converts. And so I applaud him for doing this. But writing articles that then need more articles to be written in order to satisfy a career that depends on writing articles is actually not that productive for the overall field. If you believe in my assertion that that we ultimately want to get rid of impact and have impact investing be the norm, then additionality actually doesn't make sense. And I'm happy if more people move in and not just us anymore. That's actually the objective, right? And in that sense, then we would replace merchant banks with impact merchant banks, investment banks with impact investment banks, and the new ecosystem would feast on the carcass of the dying ecosystem that's that is going to be has to die. And so in that sense, if you believe in that vision as opposed to a carve out, if you believe in an eternal carve out where there's always a carve out that needs to prove the additionality, then the argument is correct. Here.
You talked about integrity as one of your values and living a life that's aligned with the purpose of your life. How did you think about that earlier in your career when you were starting these businesses and working in tech and maybe not, working in companies that didn't have as much of a articulated mission as the work that you're doing now?
Yeah, so the question was, when you think and reflect on integrity with respect to your consciousness in your life, how did that develop a little bit in my career, and was that really pronounced earlier on, and if so, how much, right? And I would say that it was dormant and semi-pronounced. So when I reflect, when I reflect on the way that I looked at businesses, technology businesses mostly, right? Then from my perspective, I always had what's called now a multi-stakeholder view, not just the shareholder view. Yet I was also an officer of a publicly held company, Ariba, right? And so the lawyers actually tell you that they don't say black and white that you have to always maximize shareholder value, but it has to, you have to prove potentially that you're not maximizing shareholder value. And that's how the liability system works in a publicly held company here. And so in that sense, if you are an officer of a publicly held company, sometimes you don't get a choice, with respect to the choices the business choices that you do because of that legal issue. There's new incorporation models now that soften that, where you actually have to, like a B Corp, if you incorporate as a B Corp or an L3C corporation, then in this new way of incorporation, actually the mission is baked into the company's goals, and you need to report on that. So if you create a company like this, then you avoid that publicly held company issue. When I reflect on our own wealth, then I'm actually quite happy or glad that I didn't make it in oil. I never was drawn to go into oil or something extractive or some other industry that actually is clear that it doesn't have a positive impact. Technology you can really make the argument that an operating system can be used for good or for bad, right? And it's not your choice. I mean, is that whitewashing or not? I mean, we all have to live with the consequences of our choices, right? And at that point in time, I think I was motivated mostly in becoming the VP of an A-level company that's supported, by the top VCs in the Valley, which was good and which I did. And yet I did a lot of reflection already at that point in time, but my meditation and yoga practice actually developed after I quit as an executive.
I'm trying to square the model of impact investing, the goal of turning, taking the impact out of it, right, and just making it, that's investment as a norm.
Yeah.
With the current VC model where VCs in general have a terrible return profile because you have to invest in 10 or 20. Most of them are going to be duds, and you hope that one of them is going to be Google.
Yeah.
So there's something that how do you deal with that in a sense?
So the venture model, which has been incubated here in the Valley and has been working for the last 45 years, right, is a very specific model, and it only works for that model, namely if 1 out of 100 or whatever, has a 100x or 1,000x return. And in impact investing, that model does not work. And the reason for that is that the value that these enterprises create is never valued at that extreme level, right? And therefore, you need to have a different portfolio theory of how to invest. And our portfolio theory is actually, on that level that if we get 2 to 5x return on half of the companies as opposed to 1,000 on one, right? That would actually keep us whole over the long term, and that's how we manage. That's more appropriate for social enterprises as well. We're also reinventing the term sheets, because the term sheets right now are written mostly by venture capitalists. And so if a company, so for those of you, I just go 2 minutes or 3 minutes in that, for those of you who understand term sheets, I know not everybody does. But for companies, right, that provide a service, a social service, and they can monetize that and they have cash flow in the future, we sometimes tap into that cash flow as opposed to an exit strategy, right, where you sell the shares or you go public or you're bought out. And then we can bracket the returns based on the revenue or the profit sharing that we do. And I've just done a deal in India that's structured that way. And some of us even cap the potential return. I capped this one at 15%, which is not that much in India. Here it would be quite a lot. But in Indian currency, it's just the low end of commercial capital. And so we size it into this. There is a new type of investment called social impact bonds, which our foundation was the first foundation in the US to invest in the UK, which explicitly ties the financial return to social impact, explicitly. The way that it works in this particular instance is for the recidivism rates of male offenders in a county in the UK. And I think roughly about 40% of young male prisoners, when they're released from prison, end up in prison again within 12 months. And McKinsey did a study of how much that costs the society, just the primary lack of incarceration first and lack of productivity, not even all the other side effects, because they are more difficult to quantify. And so and then a brilliant friend of ours, Arthur Wood, so he put together this structure where on one, it's a three-way structure. One is us impact investors, we give the money to a coordinator. That coordinator then actually works with usually not-for-profits but also for-profits to do the services that the people who are released from prison need, like drug treatments, like job training, like rehabilitation of one form or another. So they get a predictable money stream from us and the government on the third side. And if we, in this instance, if we actually clear a hurdle rate of 7.5% less incarceration, then I get my money back. Otherwise, I lose it, which I don't like. But we restructure that later. But also, if we actually half that, then I get up to 13% in real returns. So you see that actually these are the first ways of developing financial products that explicitly tie the financial return to the social impact that we have. This principle is actually re-implemented in New York, for instance, with Goldman Sachs and homeless people. Because homeless people, now that if you know, well, you know that homeless people, when they need health services, they go to emergency care, right? And you know how much services they use, and you know how much it costs, right? And so they figured that in order they could actually save money if they provided, preemptive sort of preventative care to the homeless, if they can just figure out how to house them and all of that. So it's not that straightforward, but I think people are really working on correlating that type of social impact with financial return. Just one second. So on the sustainability side, on the green side, right, you can actually make a lot of money if you know which externalities become internalities in the market, right? Because we invested in carbon offsets at the time of the first Obama administration, and so did a lot of other people, but they did it because they thought that Obama would change, the carbon offset rules, and he didn't. So that money moved out again. We still support it because we're impact investors, not timing the market, right? But if you had timed the market and you actually would have implemented it, you could have made a lot of money on that one. On the social side, the markets don't yet have an appreciation that unless we also solve the big social injustices in this world, that the planet will not be a very happy planet. That's not understood by the financial markets yet. And so we need to subsidize that level of investment and not expect competitive financial returns on that part of the portfolio. Okay, back there.
So these subjects require our greatest thinkers, I think, right now. We're dealing with like nonprofit to for-profit transitions, the laws involved in those. And I was wondering who you just mentioned Arthur Wood is doing this project. I believe that's in the UK. I think you're referencing the same thing. I was wondering who else do you look to that we can also maybe look to as we're trying to grapple with some of these issues.
So who are some of the thought leaders in this space? And I just mentioned Arthur Wood, who is a brilliant thought leader. So the website that's one of the most insightful about capitalism and how it needs to be fixed is capitalinstitute, one word, .org. Capitalinstitute.org. And it's managed by a friend of ours, John Fullerton, who worked for JP Morgan until 2002. And then he quit, had a midlife crisis, and in 2007-8 he re-emerged, and with this new mission in life, and that's changing capitalism. And his blogs and his insights and his write-ups are really, really inspiring. And so who else would be in that camp? RSF Social Finance, one word. RSF stands for Rudolf Steiner Foundation, at the top of this one. And so they are here in San Francisco. And Impact Assets, one word. I'm on the board of it, and I chair the investment committee for donor-advised funds. We're bringing out, 2 products next year, $25,000 to invest in, fully diversified portfolio of sustainable agriculture, which is a big topic, right, globally, and another one so it's one step further into democratization, because right now, in order to get a fully diversified portfolio, you would have to invest in 6 or 7 efforts. In each one, you would have to invest, $250,000. Who can do that? Only big portfolios can do that. So we put that to $25,000, and then the investment managers of Schwab and Merrill Lynch can actually, recommend this for affluent investors. One way. So soon we're down to the 1,000 level. Who else would be thought leaders? Leslie Christensen, portfolio theory, modern portfolio theory change, and sent me an email, and I can point you to. And our foundation, Caleb Lisa's foundation, has a bunch of pointers in the end there, and then send me an email if you get stuck. Yeah. Here we go.
I think the impact investing oftentimes is compared to venture capital investing, and there's a lot of differences
Yeah. Yeah. So exits are what's referred to as liquidity for investors, where they get their money together with profits, right? And exits in the venture community, which only does equity, is one of three things: either going public, which Ariba did, or being bought by somebody that pays for it then partially in cash, or to do a management buyout, right? So those are the three exits in a pure equity type of environment. And social enterprises usually don't have the first one, so it's very difficult to go public, right? Because normally, you would not find the institutional capital to invest in that, or underwriters, or so that's usually not an option. Not always, but most of the time it's not. The second is an option, and namely, but it comes with a big risk. So think about, let's say, eHealthPoint, right? That's in the health and insurance industry, and I put together a round of $600,000 investments with Tonic friends, and it was structured as an impact deal, meaning it's a convertible note with 2% only, so really very, very favorable to the investee, not the investor. Yet if it actually if it actually converts, then you would be part of the upside later, and now it's on the verge of converting because I'm raising 2 to 4 million in equity, and if we do that, then it will convert and would then be part of the up round. So you see that that's a partial exit, but not a full exit, and yet that is very different than, which I also had knocking on my door, is big hospital chains and insurance companies who wanted to invest and become the majority investor. And if you allow that, then you could have what's called mission loss, right? And so if you allow a non-aligned investor to actually buy you out, then that might kill the mission. And that's a big debate in the impact investing scenario. We're working on putting together impact holding companies, for instance, right? But they need to be capitalized with almost like $1 billion if you want to be able to buy out significant chunks of ownership, and that's not there yet. So for social entrepreneurs who want to retire legitimately, right? If they're getting older, there's not that many options for them, without losing their life's mission. And so those are ideas to have more exits along the conventional route. Now, what we also do, so that's really buyouts or partial management buybacks also do occur, but not, the big ones financed by the banks, more sort of, smaller ones. What does occur, of course, is, mezzanine funding, and if you do have cash flow, that you tap into the cash flow. So it's a quasi-equity deal or quasi-debt deal, which we do quite a bit of that. So for those of you who are interested in that, maybe over pizza, because I'm losing like 80% of you right now. So we can talk about that later, but that's a good, yeah.
I'm really curious about what you said about transparent due diligence, because
Yeah.
due diligence ends up being a really expensive part of vetting a deal.
Yeah.
And the smaller you try and make the investment, so if you're trying to invest in say a small rural water system or something like that could have great social returns and be actually financially viable, but it's just too small to vet it, because your due diligence eats that.
Yeah. So due diligence and transparency and transaction costs and cost of due diligence is a very big topic, and that's, I think, the magic of Tonic is that we can so all the Tonic investors, they have a deep knowledge in one of the areas that they work in. And so for instance, I've worked in India quite a bit, and so I have partners on the ground in India whom I trust. And therefore, if you want to invest in India, you say, hey, Charlie, what investments do you have? I trust you. Maybe do one deal first with us, right? And ultimately, then you don't have to do the same due diligence if you trust my due diligence, right? That's how that works. And that's what I meant by radical transparency and sharing of due diligence, which is not the natural way of how these funds work. Yet we don't work with anybody who doesn't sign up for that. And then suddenly, the Tonic members have to pay $5,000 per year, to support us. We're a for-profit LLC because we don't want to have transaction. We don't want to cut any deals. We want to just be member related, so that there's no conflict of interest, right? And but if you think about $5,000 and doing due diligence to your, and having 40, 50 deals vetted for you that otherwise would cost you $30,000 to do the due diligence yourself, is actually a good deal for these tonic members. And we need to understand more how to aggregate and how to share and how to do that. Otherwise, scalability will be really, really, really hard. Yeah.
You talked a couple times about new products as a bottleneck. Are you thinking of like lack of underlying enterprises to invest in, or are these like an impact holding company that that the $3 trillion in family offices or the
Yeah.
many more trillion in pensions can put their money
Yeah.
into like a impact private equity fund?
Yeah. So the question is really bottlenecks, particularly on the product side. And so let me just share a little bit of more light on that. So one product is social enterprise that you want to invest in, a single enterprise, right, that you want to seed stage or startup stage or growth stage. And so so the question is there scarcity of supply or demand on that in that particular product slice? And with respect to seed stage, I think it's really investable enterprises. So if we had more robust investable enterprises, since the ticket size is fairly small, there would be enough capital to actually go in, and that's where the incubators and accelerators play a huge role. The more we do that, which are subsidized, the more investable enterprises come out, and that will partially alleviate that particular scarcity. As you move up the chain, and you actually get to private equity deals, which for institutional capital is $10 million and upwards, there's actually not enough deals out there. It's both things. We have not really developed these bigger deals yet. The tonic deals are getting to I told you 4 million, 5 million, maybe close to 10 million, some of them, but just some of them getting to that point, right? And once we have critical mass on that one, critical mass being, what does that mean, right? If you have really a lot of private clientele from the big banks are asking for these deals, and they want to access that. I wonder if the money will move if we have these deals. I'm skeptical, but we'll see. Now, on the product side, there's issues in certain asset classes where there's just not that many impactful deals out there. In alternative assets, hedge funds, we are invested in only 2 hedge funds because we cannot find too many that are aligned. One of them, I think it's called AWS. You can look up our investments on our website. It's fully transparent. And it's a great hedge fund. It's long short, which means that they short certain companies and go long on others. And they short unsustainable companies, which is great because I love to make money when they go under, because I believe that that's the right strategy. So it's very much in alignment with our mission, right? And they go long on sustainable ones. So perfect. I wish we had more, hedge funds like this that actually take the themes of impact investing and play them out. And the other one where we don't have as much deal flow products is actually in real assets. I talked a little bit about the extractive technology and timber and carbon offsets and biodiversity. So there's not yet many opportunities for big capital to come in, and so helping to and sometimes it might require that we would actually incubate an industry where we are willingly taking a hit. So it's a legitimate argument if you become an extractive CEO, right, and say that that's really what you want to do, and you want to do it green, you will probably not be able to make a business. And because all your competitors, it's a legitimate argument, right? They don't have to clean up, and therefore it's not on their balance sheet to clean up. And they pay their miners god-awful salaries. So if you pay them better, you will probably produce gold much more, with a much bigger cost structure. So we would be willing with our friends to temporarily, in that instance, maybe enable you to do your business and expecting temporarily lower returns in order to make you the new industry, right? And that's when critical mass is necessary because, believe it or not, $50 million to invest is nothing in order to change the industry there. You need really billions of dollars to do that, and we're working on that. But it's I don't know if we're going to be on time, frankly. But what do you know? I mean, Tarzan's does not get capitalized. Period. You know? I mean, I don't know why pension fund. Well, I know because they get a lot of money. They get a lot of returns for it. And so if you go and tell your pension fund, if you have one, right, which most of you don't, but if you had one, then you should ask them, are you what are you investing in? And if you see that, you should challenge them, right, and say, hey, why do you mess? Our son, he works for Apple now because the company that he worked for was bought up by Apple. But the 401, he says, I want the 401k when I go in retirement in 30 years. I don't want to invest in the companies that actually mess up the future of my life on the planet. It's a legitimate argument, right? Yet he doesn't have a choice yet. And so, but when you ask them, the pension fund managers, they say, oh, please don't mess up the life of the environment for my kids and grandkids. They say, oh, you don't understand risk. And they say, okay, sorry. They go back. And yet, if you ask them then and say, you show me your returns 2008, 2009, I bet you that they were much worse than mine. And so that we need to call the industry on the carpet on that one. We all need to do that, even if we don't have a lot of assets. Yeah. So, oh no, we still have 5 minutes. Yeah.
Actually, I was reading this article today in our business review on tri-sector leadership and how effective it is for a leader to have experience in government, non-profit sector, and for-profit sector.
Mm-hmm.
In your presentation, you talked about some lessons from leaders inspired, also some qualities for impactful leaders. So what is your view on experience of impactful leaders?
So the question is, impactful leaders, do they need or should they have some experience in all three sectors, that being, private sector, not-for-profit sector, and governmental sector? And the answer is, if you can, it's really great. It would be so what happens is that there's a lot of finger pointing and a lot of prejudices on all sides, and the pure philanthropists in my cookbook are as bad as the pure capitalists and the pure communists, because they usually define their success at the expense of everybody else, right? Hello, that doesn't work anymore. We need to collaborate. And so blended capital, having some experience about the terminology that they use. And we talked, I think, beforehand about hiring only A players. It was on one of my slides too. The not-for-profit sector doesn't believe that. They believe if you just hire people who want to do good, that they can have a lot of impact, which is clearly wrong. But still, they believe that, right? And it's really surprising to me. And I cannot still, with all my meditation, cannot handle that level of incompetence. And I have to work on myself, to not become impatient in that in these circumstances. Yet, they do have an understanding of, they have a compassionate understanding of the change that they want to accomplish, with people that we sometimes in the for-profit sector don't have that, right? And we can learn. So in India, in the incubator in India, I combine for-profits and not-for-profits about half-half, and magic happens because the not-for-profit folks, they learn from the for-profit folks, and vice versa, right? With the government, God, it's like, if at any point in time I would need 51% of consensus out there of what I did, I would not have done anything probably. And so I cannot really work with government myself because of that reason. And I really applaud everybody who does, and they're very necessary and very important. I think it's very, very broken. I don't have a better solution. It's awful what's going on right now, and somebody needs to tackle it. I cannot. Maybe one more or two more, and then we leave it. Yeah.
So your I-90 for the
Yeah.
foundation is incredibly transparent.
Yeah.
I'm wondering, however, from what I can tell, it's like $10 million of organic.
Yeah.
I can tell it's more than that, but
Yeah.
I'm a little confused as to then where. I mean, I understand that nonprofits don't have a talent, but I think it's because we also, people who want to go into those professions are drawn by not only challenges but by working with other A talent. Those people are also drawn by money. Like we put a lot of money into ourselves in education, so there's like expectation that let's pay back. How are you dealing with like putting this, like your resources behind your nonprofit like vision, and then also what seems to be kind of trying to draw the distinction between your more like private equity firm mentality and how Tonic works. So I'm just trying to figure out which ones are like which in your head and what you're learning from those two things.
So our wealth structure is we have a foundation that we're totally transparent about, and that's about 10 million, give or take a few. And then the people who know us know that we have about 50 million of investable assets. And so we just say we use the same strategies, but we're not as transparent for privacy reasons. And so, but then we make the claim that our approach would scale an order of magnitude down and up, and that's where the 5 million to 500 million come in. And I didn't really quite understand where you want to go with private equity or non. Yeah. And transparency, or maybe, yeah.
No, I think in your presentation you were talking a little bit about somehow like giving return on investment and exit. I think there could be debate whether or not that's even appropriate in a social separate thinking about exiting. But so I'm just trying to follow which of your investments are in the foundation.
Okay.
And then which ones are you dealing with
outside the foundation?
Yeah. I can't tell whether or not Tonic is part of the foundation.
Oh, Tonic. Okay. Yeah.
Separate, that sort of
yeah. So Tonic is a separate thing. It's we co-founded that, and we are part of Tonic, but it's really not it's a membership organization, meaning that the members do all the work. Tonic is not regulated. It's not SEC. It doesn't have a broker-dealer license, so we don't make recommendations of investments. Our members do that, right? And so really it's member. And then similar, the 100% Impact Network is also a membership-based organization that we participate in and are co-creators of, but not really. And the members really do the investments. There's no co-investment facility. They do the investments.
So you're building that for that other thing. You're building communities.
Yeah. And there's an opportunity, maybe to do a co-investment facility, maybe downstream, if we have deal flow that is interesting to these commercial investors. He's gone now. So you say, if you want to co-invest now, then we de-risk your future investment by you getting to know the deals. And that's also going on. Okay, last question, and then we'll leave it. Yeah. Last question, if there is one. Oh, okay. But we're done.